So this exercise is business combination, and the question we're going to do is D Limited and H Corporation. So the question reads, D Limited and H are both engaged in manufacturing of computers. On July 1st, year 5, they agreed to merge, whereby D will issue 300 shares with current market value of $8 for the net assets of H. And we are given the summary of the net asset of H, and we are given the fair value of H's assets and liabilities. Now, it says, in determining the purchase price, the management of D Limited noted that H has a lease of a manufacturing facility under an operating lease that has terms that are favorable relative to market terms. So you have what we call an intangible asset. So they happen to have negotiated a lease that has favorable terms against what the current market value is for those leases. However, the lease agreement explicitly prohibits transfer of the lease either through a sale or sublease. An independent appraisal has placed a value of $60,000 of the lease agreement. So what we're asked is we need to prepare the July 1st, year 5 balance sheet of D after the merger. So what we're going to do, first of all, is we need to calculate the acquisition differential. So we saw that in another video. So we're going to take a look at the purchase price. We're going to analyze the acquisition differential by looking at the purchase price, which in this case is $300,000 times $8 to give us the consideration paid. Now, we're going to subtract and compare what we paid against the fair value of the net assets of H company. So if we add, we've got assets is $4 million less fair value of liabilities, which is $1,720,000, to give us $2,290,000. Now, that gives us so that's 2290 less 2.4 million gives us 110,000. Now, we need to determine the difference of why we paid an extra $110,000. Is it goodwill? Perhaps. Perhaps. But in this question, it told us that they had a favorable lease. Favorable lease. So we need to deduct the favorable lease. Of $60,000 to determine goodwill. If we do not incorporate the $60,000, then we're going to overstate goodwill. Now, although it did say in the question that they cannot transfer the favorable lease, our handbook actually has provisions under our standard that says under IFRS 3, it requires us the favorable lease term to be recognized as a fair value as an identifiable asset in a business combination. That can be found in the standards IFRS 3, paragraph 29 and 31. And it says that must record the fair value of the favorable lease term regardless whether the lease can or cannot be transferred or assigned. It does specifically says that. And here's the rationale. The rationale says the net identifiable asset on acquisition still meets the contractual legal criterion. And that's the reason why we're actually allowing us to record. It says the asset results from contractual or legal rights regardless of whether those rights are transferable or separable from the acquired enterprise or from other rights and obligation. So even though the question says it's not allowed to transfer if they sell the business to D, our handbook specifically says because it's a contractual obligation, legal obligation, it does still meet the concept of looking for identifiable assets of D. So that's why we are, or of H, that's why we're recording it. Okay, so that's what we need to do. And by not recording it, you'll see that if we don't record this, then our goodwill is just going to be a lot higher. Our goodwill will be $110,000. Okay? So now we're going to do the D Limited consolidated financial balance sheet. So this will be a balance sheet. It's not consolidated because we bought a net asset, right? Because this is a net asset purchase. If it was a share purchase, we would put the word consolidate on here, right? So we would put the word consolidated if it's a share purchase. Okay. So we're going to write the word current asset. So we're going to just follow through. And here, current asset, we're going to first record, I'm going to use the direct method of consolidation. We're going to start with the book value. So I'm going to call this book value of D. And that's the book value of D plus the fair value of H. And that's what we're going to do. This is called the direct method. And I know in your textbook it shows you the worksheet method, but to facilitate a faster consolidation process, we actually recommend that you use the direct method for solving these consolidation questions. So I always like to start with the parent, in this case, the purchaser, which is D company, and of course the acquiree, which is in this case H. And I forgot to put July 1st here. Next, we're going to have non-current asset. Again, we're going to start with the book value of D company plus the fair value of H company Then we're going to record the intangible asset. This is the lease contract. And you're going to amortize this asset. So you're going to amortize this asset over the remaining useful life. So as D operates and as a combined entity, a merged entity between D and H, they're going to amortize this over the remaining useful life of the lease. And of course, we need to record goodwill, which is tested for impairment. And it's done yearly. Okay, it's tested for impairment every year. And our handbook basically says the test for impairment doesn't happen at the end of the year, but it must happen at the same time each year. So obviously, whenever the company deem, appropriate. So if they have a July 1st year end, they may test it in June or perhaps in April. But our handbook says it must be tested the same time each year. It doesn't have to be at year end. Okay? 9,520,000. And we've got current liabilities. Again, we want the book value of D plus the fair value of H. Long-term liabilities. Book value of D and fair value of H. Now, common shares, remember, they had, it's only on, this is H, this is D only, right? So first we're going to have 2.5 million plus, remember, we acquired the business using shares, right? This is common shares. So we're going to add this common share to here. So for being a mess here, but get the point anyway. And retained earnings is only D only. Okay. To give us 9,520,000. So to recap, this is a net asset purchased, and we purchased the net asset of D of H. D purchased net asset of H using common shares. So they issued 300,000 shares. We have to use the fair value. That determines the price. Then we need to analyze why we paid 2.4 million. So we have to look at the fair value of the net asset of H. And this was given to us in a question. Then we have an acquisition differential, and this is what they call acquisition differential. That's what it's called. And this acquisition differential, we have to analyze based on what else was not recorded on the books of H. And of course, one of them was the lease contract, that's 60,000. And we saw that under the standard IFRS 3, paragraph B29 and B31, is we must record the fair value of the favorable lease, regardless of whether the lease can or cannot be transferred or assigned. Why? Because we need to be able to identify what are the contractual legal obligation, and that's what we need to do, is we need to be able to separate out all of our contracts, our legal obligation criteria, to separate out all of these intangible assets to determine goodwill. If we didn't do that, we would overvalue goodwill. Now, when we're doing the combination, the merger, If it's a net asset purchase, we just call it a balance sheet because these the H's fair value of the net asset will be recorded as part of the acquisition on the books of D. If this was a share acquisition, in other words, we didn't buy the net asset, we bought the shares of H, then we would actually do a consolidated balance sheet because the legal entities of H and D must be separated, and at the end when we report them we have to consolidate. And we always start with the book value of D plus the fair value of H, and you notice that we need to record the intangible asset and the goodwill, which is only tested for impairment. Okay, thank you.